All right. So the big, beautiful, yes, that's intentionally spelled that way, bill. I want to go into some more detail on this because it's important because it affects all of us. All right. There are going to be significant changes in Americans, that's plural, personal finance. So this bill, which is no longer a bill, it's law, locks into Trump's 2017 tax cuts. That's the most important thing it does is sustains those into permanent law. They don't expire. Now, obviously, the next Congress could come along and overturn this law. They would have to have a substantial majority to do it. It cannot be done with reconciliation. So it would need a 60 vote majority in the Senate. Okay. So, including deductions for tips, you've been hearing about this. Waiters and waitresses love this. Overtime pay, auto loan interest, that's come back after about 10 years, 12 years that we didn't have that as a write off, unless you were a business. All right. And this special $6,000 deduction for seniors. We'll get into that in just a few pages here. At the same time, the Republican backed bill enacts significant requirements. That's the operative word, requirements, not cuts. All right. It means that if you want to receive Medicaid benefits, again, you didn't pay for these, right? Medicare, you're paying into. Social Security you're paying into, that is an earned entitlement. Medicaid is a free entitlement. And if you're going to accept that, you need to prove that you are totally disabled and cannot work, or you're a single mother or father with, I don't know how many kids, but it's more than two, and you can't work any at all, and then you'll continue to get your benefits. But you can see where this is going. The majority of the people that have been receiving this will receive it if they need it. If they don't, they're going to not be on Medicaid and food assistance. All right. I understand that the tax incentive for clean energy is disappointing to some too, but basically the overhaul of the federal student loan system has needed to happen. You've seen the battles in this. What we're trying to do, again, it's very difficult not to tiptoe into social commentary here, but as a portfolio manager, when I see the populace in general having their discretionary spending altered because they're having to direct money to necessities away from discretionary, that's when I have to really pay attention for you, because it affects the kinds of stocks we're buying. We might buy more of Procter & Gamble and less of Nvidia if people are turning to more necessities than discretionary spending. But at the heart of this legislation is the permanent extension of the Tax Cuts and Jobs Act during his first term. That law reduced marginal tax rates, and that's a good thing, 2 to 4%. The standard deduction will increase now to $15,700 and $31,000 for married couples. That means if you're making less than $31,000, you're not paying a nickel. Realize that more than 50% of Americans do not pay any substantial taxes, federal taxes at all. So this is further help to those to get basically to join that class of people that aren't paying, but it does keep that money in the discretionary spending category, we hope. At least that's what the current administration is running. This is called supply side economics, all right? That if you just give people enough money and they spend, it will increase revenue, it will increase overall tax revenue by giving them tax cuts. I know it seems contradictory, but it's not. The child tax credit card, let's try it again. The child tax credit grows, it's a lot of data, folks, grows to $2,200 and then up to $1,700 refundable with future increases indexed to inflation. There's a couple other benefits here, which I'll get to, but all of these are reductions, all right? Tax reductions. Republicans like tax reductions. They're supply side people. They believe if you reduce taxes, people will take that money and spend it, which makes more widgets for the companies, and they report higher earnings and stocks go up, etc. But rather than essentially fully eliminating taxes on Social Security, the bill provides a $6,000 annual deduction. All right, it's important for you to understand they're not just erasing the Social Security tax that you have to pay, but they are giving you an annual deduction. So the deduction phases out if you make more than 75 as a single person or 150,000 as a couple. And if you make more than 175, you're not going to get the deduction at all. So when you see in the news, oh, the people over 400,000, they're going to love this. No, it starts at 175. The average working person that's making under 175,000, and I think that's about 70% of Americans, are definitely going to benefit if they're working in retirement or they're getting their Social Security benefit and they've stopped working. It's no longer going to be taxed, all right, because they're going to use this credit. The Social Security Administration, that's SSA, estimates that nearly 90% of beneficiaries will see no federal taxes on their benefits under this change. Read that again, please. The SSA estimates that nearly 90% of the beneficiaries will see no federal taxes. So, this act should provide immediate relief to seniors. That would be quite a few people on this call, but not all of them, have spent a lifetime contributing to the nation's economy, and that's most of us. All right. I'm just going to pause and say that I even got an email from the Social Security Administration saying, "We heartily approve of this. It's going to make things more solvent for us." Very good. And you guys are going to be glad you don't have to pay more taxes. You're going to get a break on that, except for you real big earners, and then you don't really care. So that's a big benefit to many of the people watching this program. So these expanded tax breaks under the bill will reduce the overall tax burden on Social Security recipients by $30 billion each year. And that's not from White House, that's from the Tax Foundation. If you look in the footer here, you're going to see a whole lot of credits, the longest credit line I've ever had, because we used a lot of sources to compile this data. So as I said earlier, I want to be sure you understand, is there no tax on Social Security? Not quite. What the tax mega bill really means for seniors is this: the enhanced standard deduction will offset what recipients pay in tax benefits. All right. The enhanced deduction, which expires in 2028, conveniently when Donald Trump leaves office. So the next person coming in, whether it be a Republican or Democrat, will have to face, are we going to extend this? All right. So the drama is already set for us for 2028 and 2029. All right. But it means that people age 65 plus can claim a $6,000 deduction if their income is $75,000 or less, or married couples up to $12,000 if their combined income is $150,000 or less, right? That's most people. So the deduction begins to phase out, as I mentioned earlier, 175, and for couples with an income of 250, it's just not going to benefit them. This is a cool feature. One of the bill's novel features is the creation of a new Trump account for children born 2025 and through 2028. Now, this can be for your children. It can be for your grandchildren. All right. Pretty cool. So let's see how this works. Under the provision, the federal government will make a one-time $1,000 deposit for every eligible child who is a U.S. citizen. Parents can contribute, and grandparents should have put that in there, but they can, up to $5,000, with investments going into a tax-deferred fund that tracks the S&P. For the first time, holy cow, the government is actually offering an indexed fund that's tracking the S&P as opposed to putting it in Social Security. Who knows how they've invested our Social Security money? We didn't have any choice in that. And I'm sure I would have chosen differently than the government did. But this is a step forward into the 21st century. All right. It's a good thing. Withdrawals from the account will be taxed at long-term capital gains as opposed to short. Remember, you're funding it with short-term money, so you should be taxed as short-term gains, but it's not. It's going to be long-term gains used for qualified purpose, and a qualified purpose is for education.